What is a credit score, and why should I care? Imagine you're about to buy your dream car. It's a moment you've been waiting for, and the excitement is palpable. You can already picture yourself driving it, feeling the smooth ride and enjoying the new car smell. You've saved up diligently, cutting back on unnecessary expenses and putting away a portion of your income every month. Now you're finally ready to make the purchase. But before you can drive off the lot, the dealer needs to check your credit score. This is a standard procedure that helps them determine your financial reliability. This 3-digit number, ranging from 300 to 850, tells them how responsible you are with money. It's a quick snapshot of your financial health. Think of it as a financial report card. Just like in school, where your grades reflect your academic performance, your credit score reflects your financial behavior. A good credit score, typically above 700, means you're more likely to get approved for loans and credit cards with better interest rates. This can save you a significant amount of money over time. On the other hand, a low score could mean higher interest rates or even getting denied for loans altogether. This can make borrowing money more expensive and challenging. Your credit score is essential for more than just loans. It's a critical factor in many aspects of your financial life. For instance, landlords use it to screen tenants. A good credit score can make it easier to rent an apartment, while a poor score might limit your options. Insurance companies also use your credit score to determine premiums. A higher score can lead to lower insurance costs, while a lower score might result in higher premiums. Even potential employers might check your credit score as part of their hiring process. They see it as an indicator of your reliability and responsibility. In short, your credit score impacts your financial life in many ways. It's not just a number, it's a reflection of your financial habits and decisions. Therefore, it's crucial to understand what it is, how it's calculated, and most importantly, how to improve it. By managing your credit responsibly, you can open doors to better financial opportunities and a more secure future.
Breaking down the FICO score, your financial report card. Your FICO score is a crucial part of your financial health, much like a report card in school. It tells lenders how reliable you are when it comes to managing credit. The most common credit score model is the FICO score. This score is used by the majority of lenders to assess your credit worthiness. It ranges from 300 to 850, with a higher score indicating lower credit risk. Essentially, the higher your score, the more likely you are to be approved for loans and credit cards and to receive favorable interest rates. 5 key factors determine your FICO score. These factors are designed to give a comprehensive view of your credit behavior. Payment history, which makes up 35%. This is the most significant factor because it shows how reliably you pay your bills. Paying bills on time is the most crucial factor. Setting up automatic payments or reminders can help ensure you never miss a due date. Late payments can significantly hurt your score. Even one missed payment can have a lasting impact, so it's essential to stay on top of your due dates. Amounts owed, which accounts for 30%. This factor looks at the total amount of debt you have and how it compares to your available credit. This refers to how much you owe compared to your credit limits. Keeping your balances low relative to your credit limits is key to maintaining a good score. Lower credit utilization is better. Aim to use less than 30% of your available credit to keep your score healthy. Length of credit history, which is 15%. This factor considers how long your credit accounts have been open. A longer history generally leads to a better score. Keeping older accounts open can be beneficial, even if you don't use them frequently. Credit mix, making up 10%. This looks at the variety of credit accounts you have, such as credit cards, mortgages, and auto loans. Having a mix of credit types, like credit cards and loans, can be beneficial. It shows lenders you can manage different types of credit responsibly. And lastly, new credit, which is also 10%. This factor considers how many new accounts you've opened recently. Opening too many new accounts in a short period can lower your score. Each new application results in a hard inquiry, which can temporarily ding your score. Understanding these factors is the first step to improving your credit score. By focusing on these areas, you can take control of your financial future and work towards a better score. Setting financial goals and creating a plan to achieve them can also help improve your score. Whether it's paying down debt, making timely payments, or diversifying your credit mix, every step counts. Consulting with a financial advisor can provide personalized strategies to boost your score. They can help you understand your credit report and identify areas for improvement. Regularly monitoring your credit score is also important. It allows you to track your progress and catch any errors or fraudulent activity early. If you find any inaccuracies on your credit report, dispute them immediately. Correcting errors can quickly improve your score. A good credit score opens up many financial opportunities, from lower interest rates to better loan terms. It's worth the effort to maintain and improve your score. By understanding and managing the factors that influence your FICO score, you can build a strong financial foundation and achieve greater financial stability. Your financial report card is a reflection of your credit habits. Make it a good one by staying informed and proactive about your credit health.
Spotting and fixing errors. Cleaning up your credit report. Your credit report is like your financial transcript. It's a detailed record of your credit history, reflecting your financial behavior over time. It contains information about your credit history, including loans, credit cards, and payment history. This report is used by lenders, landlords, and even some employers to assess your financial responsibility. It's crucial to ensure this information is accurate. Errors on your credit report can lead to higher interest rates, loan denials, and other financial setbacks. You can get a free copy of your credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, annually at annualcreditreport.com. This allows you to monitor your credit regularly and catch any discrepancies early. Carefully review your reports for any errors, such as incorrect personal information, accounts that don't belong to you, and inaccurate payment history. Look for misspellings, wrong addresses, and unfamiliar accounts. Pay special attention to your payment history and account balances, as these have a significant impact on your credit score. Even small errors can affect your financial health. If you find any errors, dispute them with the credit bureau immediately. You can do this online, by phone, or by mail. Provide any supporting documentation to strengthen your case. The credit bureau is required to investigate your dispute within 30 days. Once resolved, they must provide you with the results in writing and a free copy of your updated report if the dispute leads to a change. Regularly cleaning up your credit report ensures that your financial record is accurate and up to date, helping you maintain a healthy credit score and better financial opportunities. The golden rule: paying your bills on time, every time. This one is non-negotiable. Late payments can stay on your credit report for 7 years and severely damage your score. Set up automatic payments or reminders to ensure you never miss a due date. Even if you can't pay the full amount, make the minimum payment to avoid late fees and negative marks on your report.
Credit utilization is the amount of credit you're using compared to your total available credit. For example, if you have a credit card with a $10,000 limit and a balance of $2,000, your credit utilization is 20%. Aim to keep your credit utilization below 30%, ideally below 10%. High credit utilization can signal to lenders that you're relying too heavily on credit. Pay down your balances strategically, focusing on the cards with the highest utilization rates first. Every time you apply for new credit, a hard inquiry is added to your credit report. Too many hard inquiries in a short period can lower your score, especially if you're already considered a risky borrower. Only apply for credit when you need it and have done your research. Avoid applying for multiple credit cards or loans simultaneously.
The longer you've been managing credit responsibly, the better. Lenders view a long and positive credit history as a sign of financial stability. Keep your oldest credit accounts open, even if you don't use them regularly. Closing old accounts can shorten your credit history and potentially lower your score. Having a mix of credit types, such as credit cards, installment loans like auto loans or student loans, and mortgages, can demonstrate to lenders that you can manage different types of credit responsibly. However, don't feel pressured to take on debt just to diversify your credit mix. Focus on managing your existing credit responsibly and only take on new debt when necessary.
It's your right to dispute any inaccurate information on your credit report. Contact the credit bureau directly and provide documentation to support your claim. The credit bureau is legally obligated to investigate and correct any errors.
If you're new to credit or have a limited credit history, a secured credit card can be a good option to start building credit. Secured cards require a security deposit that typically equals your credit limit. This deposit minimizes the lender's risk. By using the card responsibly and making on-time payments, you can establish a positive credit history and potentially qualify for unsecured credit cards in the future.